Hello, and welcome to The Pitch, brought to you by Livewire Markets. I'm Hunsley, and if we've learned anything from this current economic cycle, it's that one size definitely does not fit all. So, to discuss how this cycle is affecting where he sees value in his asset class, I am delighted to say we are joined by John Stover of Tribeca Investment Partners. John, welcome.
Thanks very much for having me.
So, John, we're starting to see, as I said, some dissonance, if you like, between central banks. We've got central banks in the West starting to cut rates. In Asia, the macro picture is a little more nuanced. Japan is incredibly hesitant about raising rates, and then China's loosening policy. I guess, just to start with, how is Asian credit, in your view, positioned with this macro nuance in mind?
Yeah, I think this interest rate cycle is pretty unique in the history of the modern economic world, right? So you have obviously China as its own animal. You've had deflationary forces there. Rates, government bond yields are at all-time lows actually. Japan has obviously had multi-decade record lows of interest rates, and actually, those interest rates are starting to come up. At the same time, U.S. is obviously starting the rate cutting cycle. The other interesting thing about it is emerging market Asian rates have actually been lower this time of the rate hiking cycle than what you see in the U.S. And that's unique in the history, again, of the modern economic environment. So historically, always Asian emerging market rates have been higher than the US because inflation's been higher in those countries. And this time around, US inflation is actually higher. So, if you look at our portfolio, we invest actually in over 90% US dollar bonds. So from that perspective, we're more exposed to the US rate hike and rate cutting environment. And we invest in over 95% fixed coupon bonds. So when the US starts cutting rates, that's a big tailwind for us. What you are also seeing is emerging market Asian countries, Indonesia, for instance, just cut rates. So you're going to see them start to follow the Fed. That's going to be helpful for economic growth in those regions. And I think that's going to benefit our portfolio.
I think when we also talk about credit, you've mentioned yields and spreads, but the other conversation point is always about defaults, and that's always the other great risk. Now, here in Australia, depending on the metric you look at, corporate defaults are at highs we've not seen since the early 1990s in the US. It's at the highest level since the GFC. From your standpoint, how is the default landscape looking like across Asia?
Yeah, Asia, so you have to sort of split it between China property and everything else. I think what we're seeing in Asia is actually the default cycle came a little bit earlier. And all these companies had to go through that period where they didn't have that refinancing channel open. So I think what we think going forward is defaults are probably going to rise in developed markets like US and Australia, and you're already starting to see that, particularly on the private credit side. I think there's a lot of risks there. But in Asia, we've sort of already gone through that really difficult environment in terms of the market and the refinancing channels. So I think you're likely to see probably defaults actually lower in Asia this part of the cycle, going into even a potential recession in the US than you might see in the developed markets, just because they haven't gone through that experience over the past few years.
And just to clarify, does your portfolio does not have any exposure to Chinese property developers?
Correct, we don't have any.
Okay.
But we've avoided that. We even made some money shorting it over the past few years. And we currently don't have any exposure.
Fair enough, okay. So with that said, you've already alluded to it just a little bit there at the end. Can you tell us a little bit about your investment process, both in how you seek out winners and I guess also how you identify companies that could be short opportunities too?
Yeah, so in terms of what we're looking for, on our long portfolios, we're really looking for companies that are producing cash flow and paying down debt. So we look for, declining leverage profile over the next few years, and we're looking to find opportunities where we have a variant perception relative to the market. So, for instance, on the long side, where we have a more positive view than the market on where that leverage trajectory is headed, and where we think the yield that's on offer in the market isn't really factoring that in yet, right? So, we spend a lot of our time modeling out company cash flows, balance sheets, looking through, the balance sheets and trying to understand not only where that leverage is headed, but what options for refinancing that the company may have. Because what we care about is obviously getting paid at par at maturity, right? And so we spend a lot of time even thinking, doing many cases in our scenario analysis and trying to understand, okay, even in a downside case, what levers does the company have to pull to repay that bond at maturity? On the short side, it's a bit of the opposite, right? So we're really looking for trying to find a situation where we have a more negative view than the market, and where we don't think that's accurately priced in. And then, most importantly, what we think on the short side, we try to find some near-term catalyst for that to sort of re-rate in the market. Much more so, we can be a little more patient on the long side. for the short side, we try to have a near-term catalyst that's going to re-rate the price of the bond over the next 2 to 3 months.
Forgive me for being curious, but if you had to, the split between the time you spend looking at long opportunities and short opportunities, how much time do you spend looking at one or the other?
Yeah, I'd say it's probably 75% long, 25% short. The short side, we tend to have about 30% of our portfolio in single name shorts, and then the remainder of that we express through index shorts. So we have a pretty high bar for putting a single name short on. So we do spend more time probably on the long side, but when we do find an interesting short opportunity, we do tend to dig in pretty deeply.
Yeah, no, absolutely. Okay, so putting all that together, where are you finding the biggest rewards for the lowest risk in this environment?
Yeah, look, we really like India right now. That's a great macroeconomic story. We're finding good value there in the renewable space. That's been a key long for us, probably for the past couple of years. And for a double B credit, these are strong, high yield companies. Those are 8 to 9% yields, and these are companies that are producing assets. They have long-term offtake contracts with government entities, and so much better value than what and strong sponsorship. So one of the largest positions we have is owned by the Singapore Sovereign Wealth Fund, their majority shareholder. So much better value than what you're seeing for double B credits elsewhere in the world, say in the U.S. or Europe. We also like Indonesia. We still like the macro trajectory there, and that's again been a pretty key position for us over the past several years. We also are finding some interesting things to do in Macau. That's something that has been kind of a good, sort of a bright spot in China's COVID reopening, but the valuations in the market haven't really reflected that. And we think, what's going to happen, some of the stimulus coming through, particularly on the consumer side that we've seen over the past week from China, is going to benefit that region.
Finding opportunities in Macau. I think we're all going to go to the casino. John Stover of Tribeca, thanks very much for joining us.
Thanks very much.
And thank you for joining us for The Pitch. If you enjoyed that interview, you can subscribe to the Livewire Markets website, as well as our YouTube channel, where you can find more episodes of The Pitch. We'll see you again soon.